Okay, so the sharing that I'm going to give, right, this is the reading that I read from Stocks for the Long Run. This book was written by Jeremy Siegel. So he's the professor of Wharton School, I think. One of the famous professor that show up on CNBC. I think if you recall his interview, right, he's someone who is more vocal. Like when he speaks, he's a lot of emotions in his speech. One, I think one of the most recent video he mentioned that the Fed should cut rate and so on. So it's very dramatic But if you read his book, right, actually the impression is very different because all these books, right, as like he's a professor, right, it's all backed by a lot of tons of all this study data and so on. So it's very convincing when he make a point Okay, the first one, right, I just want to mention. I think today's topics, today's sharing is mainly on talking about valuation. Talking about like, in the past I mentioned that if we read all these charts, right, showing let's say like cap ratio or PE ratio or buffer indicator, all these indicators are pointing towards market is overvalued. As I read this book, there are few points that I think disagree with this kind of view. For example, like what's the right PE ratio and what's the right valuation ratio basically? Like how should we interpret today's PE? Is it high or is it reasonable or is it... I think nobody will say today's PE is low but some will say that it is high and it will come down soon. But some people say that actually this high PE ratio is kind of like justified. Then we will go through the details on to look at whether it is justified or not. Okay, so the first chart that I'm showing here, right, this is the dividend yield, which is all this dotted line here, dividend yield versus the nominal bond yield. Nominal bond yield is very simple. For example, let's say if you buy a 10-year bond, right? So if the 10-year bond give you, let's say like 3.5% or 4%, so that's the 4% yield, the nominal bond yield, meaning that if you hold this bond to maturity, you are going to get that nominal yield. So if you look at the history, right, this is very, very long data. It's from 1870s until 2020. So you have like 150 years of data here, and you can see that for most period, right, let's focus on the first half year, right. So you see there's a crossover here. So this is up until 1958, right. You see that this black line is below the dotted line. What they're saying is that for long stretch of period, right, the dividend yield is higher than nominal bond yield. So I think, and then this one also is things that make sense back then. You just imagine that you observe your data we are currently sending at 1958, right? Because stocks are risky, okay? Bonds are less risky because bonds, it is contractual cash flow, right? For stocks, many things can turn bad. If you are investing in stocks, you're actually expecting a higher returns, right? And usually higher returns, what it means is that you get a higher dividend yield. If you invest in stocks, lower risk, lower return. And now this yield and return is, back then, right, is like, that's how you see the returns, right? Because I think when it comes to stock investing, mostly shareholders are expecting dividends. I think back then there isn't so much like all this cash buyback and so on. It's less, it's not saying there's none, it's just that relatively less compared to recent period. The delta, right, or the difference between these two lines, right, this is the one that tells us about the valuation. Because say for example, if the stock market is very high, right, then you buy at a high share price, you are getting a low dividend yield. So if you look at all this dividend yield when it is very low, right, for example in 1900 or let's say this period close to 1930s where this dotted line here is very, very low, right, what it means is that the stock market is expensive. And which is true, like in the 1930s there's a huge market crash, right, after the market become overvalued in the late 20s, right. So it just like strengthening the belief that as stock market go up, dividend yield come down. As and when dividend yield come down close enough to the nominal bond yield, it tells us that the market is expensive, and it tells us that you better sell your stocks, stay away from the market. Then these things repeat again in 1958. You see that there's a crossover here. 1958, market looks good, dividend yields are down. And then if you look at the past history, and at 1958, you make a decision to say that, okay, now market is expensive, let's sell my stock. I'll buy it back later after the crash or after the corrections, right? But the problem is that if you have that decisions made in 1958, right, then you are actually missing the long bull market, very, very long bull market. Even you want to wait for the next drop in market is like in the 70s. So 1958, wait until let's say 1974. That's like 10 plus years of waiting to have this kind of pullback. And even after the pullback, you still need to buy it back at a level that you sold at. So I think this one, right, just to tell us what, although a lot of all this, let's say story, or let's say all these indicators that we're reading, right, we can kind of like make sense of the market, or of where are we using all these indicators. But sometimes all these things can, like change permanently. Okay, maybe it's true like in the period before 1950s, these indicators of using dividend yield versus nominal bond yield is a good indicator to tell us whether market is expensive or not. But there will be there will be change in the structural market or economy that say that, okay, this type of indicators no longer useful. So this one just something to bear in mind. You see, suddenly the delta between dividend yield versus nominal bond yield is not a good measure anymore, because I mean, what's the use of indicator if it tells you to sell and then after you sell you just miss the long bull market, right? That's something to watch out. Just like I mentioned about dividend yield, right? Actually, what happened after this period, right? I can't recall exactly which period, but in the recent decades, what happened is that there's some change in the tax code. So it resulted in, if you are corporates, right, you will rather use your money to do share buyback instead of declare it as dividends. From there onwards, more and more firms they do share buyback when they want to return the capital to shareholders, because it's like more tax friendly. So what happened is that the dividend yield become like a lot lower, right? So in this period, if you look at the period between 1960 to 210, right, if you invest in stocks, you know that you are getting a low yield. Stocks yield is low, but that's fine, because in total return equations, right, the dividend is only part of the total. There's another part which is the price appreciation, right? And the price appreciation is always tagged to the earning per share. And as there's more and more all this share buyback, right, it shrink the outstanding shares, and then what happens is that the EPS, right, the earning per share will get push up. So that's actually form the majority of the gains for shareholders instead of like just relying on the dividend yield. Then the next one, right, the name is Buffett indicator because this is really popularized by Warren Buffett. His one is actually simpler. Like there's not much interpretation here. It's just the total market cap to GDP ratio. And by market cap, right, based on Buffett definitions, right, the market cap is US stock market cap, okay? And the GDP ratio is also US GDP ratio. And if you look at this chart, right, again, we are looking at this and saying that as and when this this percentage gets very high, right? I think when he popularized this, I think it's like around in the 20s, it became quite popular. And you can see that around, let's say, dot-com bubble period, right? Around 2000, the ratio, right, is like 169%. And then after it peaks, right, there's this dot-com crash, then crash back down to somewhere around, let's say, 80%. So you can see that this one, right, is quite useful, right? Because if you look at the US economy and US market, right, the market cap is like all these earnings coming from the US corporates. And then the GDP is a measure of economic activity. By right, there's like a correlations, or there's a relationship between the overall stock market capitalizations versus all the activities in the economy, right, which is the GDP. If this ratio get really totally out of whack, like totally too far away, where you can see that this percentage is getting too high or too low, it tells us something. It tells us about the market valuation. So there are people who look at this and say that, okay, then if we look at this percentage is high, then we will just like sell our shares. And if this is low, for example, during period in 2009, that's when to buy, right? And in fact, I think Buffett was very cautious during this period, and also he's getting very aggressive in 2009 period after the global financial crisis. So I think it is quite useful. But one thing to note is that if we say that this indicator is useful, right, by right there should be a range, right? You can say there's a range where higher than this certain threshold, market is expensive, below certain threshold, market is cheap, and this range it should range bound, right, rather than trending up. You see there's this dotted line. It shows that over time, this period, this market cap over GDP kind of like trending up over time. The trending up is like quite funny. Like, why should it trend up, right? Because if the relationship is something that makes sense, right, but right, there should be a reasonable range where it just oscillate around this range, right, this line. But it's not. It's like trending up and down. Then I read this book, Jeremy Siegel. He basically mentioned there are a few things. There are two things that was not mentioned here. So for those, you can read the text here also. I think that's a good explanations. So the first one is actually the talking about this market cap indicators, right? Market cap is the sum of all the companies in US stock market. Okay, you can take S&P 500 market cap, doesn't really matter. But this one tell us how many firms are listed. Okay, and it tell us like number of firms in this pool, right? And these numbers can change over time. Right? Say, for example, during when market is good, there are more companies doing IPO. Hence, there's more companies in this bucket, right? So it usually push up this percentage. But the GDP is still the same, right? So when you compare market cap versus GDP, there's something like a not apple-to-apple comparison here already. And then the second point, right, which is I think more important, is that when we look at this market cap, right, the market cap is the worth of all the companies. These companies include companies like, like Apple, Microsoft, and so on. And then there's more and more earnings or revenues and earnings that actually contributed by sources outside of US. Okay, say for example, like Microsoft sell their software to the world, right? Apple sell their iPhones to the world. So if you look at the trend, right, actually over time, there's larger and larger percentage of revenue and earnings that's contributed by user or consumers outside of US. This one is not recorded in the GDP, but it's recorded in the corporate earnings of US firms. So that's why it boosts up the market cap of all these like companies, but it didn't boost up the GDP. So, and if you take this upward trend, right, if you account for that, actually it explains that why this Buffett indicators is getting higher and higher. And so if you look at this 212%, right, this may not be a apple-to-apple comparison compared to, let's say, like 20 years ago around dot-com bubble, because you need to account for all these, differences or all these details, right? Let's say how much of the revenue and earnings contributed from outside of US that's not recorded. So I think when people do these kind of things, like let's say Buffett, when he's coming up with this indicator, I think it's useful indicator. It's just that sometimes it is relevant for that period. And over time, all this data, it will drift because some structural development in economy or in like stock market and so on. So need to know all these details. We cannot simplify such a complex concept and topic to just like one number, right? Say that, oh, Buffett indicators say this. So I think that's the dangerous things if you keep things too simple. So this is also quite interesting. Then another one, this one, there's no chart here. Just some words here. You can, look at the text. I think this is also quite interesting because I also debated with, let's say, my bagpodholder pods crew, right? We say, okay, when talk about PE, is PE of 30 to 40, is it high or not? Even if you look at S&P 500 PE, which is relatively high now compared to history, but is it really high? Because there's no magic number to say that, above certain threshold is high, below certain threshold is low. So all these are, subjective, right? So, and then this part, right, just want to mention that there's basically the author is trying to argue that, yes, it looks high now, the PE, but it's justified. And why is it justified? One reason is because drop in the transaction cost. So I think his argument goes like this, right? He says that in the past, return on equities, right, a real returns is measured at around 6 to 7%. So if you look at this 6 to 7%, right, you just like take 1 divided by 6.5%, right, you get something between 15 to 20. You're not going to get 20 because if the PE is 20, then the yield is 5%, right? But you are getting 6.5%. So it's lower. The question is that, okay, because back then, right, the transaction cost is very high. And if you want to maintain a portfolio that is truly diversified, right, you still need to do the trading to rebalance the portfolio so that your portfolio is diversified. And as and when you do all these transactions to do all this rebalancing, right, you're actually incurring quite a significant amount of fee, okay? It's either you like do all these things, instead of like getting 6 to 7%, you're actually getting something like 5% just because of all these transaction costs. Or you are forced to keep a portfolio that is more concentrated, less close to an index, and because they are concentrated, the risk is higher, so you actually cannot afford to pay too much. The level of the price should be low enough to compensate you for the risk. Okay, so either way, right, the reasonable valuation should be something that is lower. Let's call it like 15, right? It should be close to 15. But recent years, after all this transaction costs has came down, right, actually all this buy and sell is actually getting very, very cheap. And because like just to get a stock index kind of portfolio, you don't need to incur all these charges. So basically you don't have that, like let's call it like 1 or 2% hit to your returns when you construct your portfolio, right? So what it means is that to get a comparable expected return, right, you can now afford to pay more. Like let's say you can pay PE 20 to get back the same level of returns compared to the investor in like let's say 50 years ago. So this one just shows that as transaction costs come down, the reasonable level of market value in the sense of PE will get higher, and yet you come back to the same net returns. So I think this is quite interesting. So it just say that all these transaction costs actually play a role in like setting where's the reasonable level of PE. So I think this This is good. Okay, so I think this is just for the context. You know, this is like forward PE. I showed this chart before. You can see that right now it's around like 20. So 1/20, the earnings yield is around 5% compared to in the past of like much lower. Let's say if you look at 1985, it's much lower, right? You need to remember the difference in transaction cost. The net returns may not be that different, right? This one is the same thing again. I think the story is the same. Like if you just look at this line, you might say that market is expensive, but there are many things that we overlook when we compare all these lines, because the earnings could be different, the situation, the transaction cost will be different, the amount of revenues coming from other geography are different, and so on. Okay, this one also quite interesting. Just want to, because when we talk about PE, right, there's one thing you need to know, that what is the earnings? And the earnings, the concept of earnings, let's say if we just focus on one company's, right, it's quite easy. You look at the financial statements, right, you just read the earnings, that's the numbers, right? It's quite straightforward. But if we talk about like what's the S&P 500 earnings, or what is the S&P 500 PE ratio, right? How do we derive this number? This is also quite interesting in a way that there are things that become complicated as you look at the index rather than just looking at a single company. So I'll just tell you like, okay, take this example given in the book, right? It says that let's keep things very simple, because I just want to share with you the reasons of, like, you look at this blue line, right? During, let's say 2009, right? The earnings actually just fall off the cliff. If you look at the PE ratio during this kind of period, right? You can see that the PE actually shoot up to almost like a super high level, because earnings dropped to like close to zero, right? During those periods. So you see this is the PE, like GAAP reported PE, operating PE. In both cases, right? Around global financial crisis 2009, you see this line, right, is getting shot up very high. And the reason is because of this situation here, right? Because during recession, there will be companies, like a handful of companies, usually they are large companies, and usually they are banks, right? Banks, they can have tons of all this write-off, right? And that hits the earnings of that single year. There's a lot of losses. And how those losses affect the PE of the aggregate market, right? So just to illustrate this, just imagine that there's only two companies here, right? So company A and company B. So company A, the PE ratio is 20, market cap 200 billion, and the earnings is 10 billion. So PE 20. And company B, right, because they are losing money, so the earning is negative 9 billion, market cap is 10 billion, and there's no PE because earnings is negative, right? But you can calculate the weight of these two companies. Imagine that the index only have these two companies. So it's like 200 divided by 210, you get 95%, and then the other one you get 4.8%. If you are investing in this index, right, actually, are you worried about the PE? To me, it's like you don't have to worry, because most of your money, right, is 95% invested in company A, because the market cap is big, right? So, and 95% is investing in a company with PE of 20. 20 is also, let's quite like reasonable, right? But if you look at the PE of this index, right, so they will actually calculate the earnings of two firms combined, which is the 10 billions plus the negative 9 billion, you get 1 billion. And also you compare this ratio versus the total market cap, which is 210 billion market cap. If you calculate the PE of this index, meaning of these two companies, right, you get something like 210. So you see where's the problem, right? As and when there's companies that have all these losses, right? And if it add together with the index, right, you will see that the PE of the index actually skew upward. And it can skew upward a lot depending on the losses of these companies. But this doesn't make sense, because anyway their weight is very small. If it is small, it doesn't matter, right? But if you just look at the PE, you will thought that the PE is very high, or you are paying a lot just to get earnings that is very small. But these two firms, right, let's say if you invest in this index, right, this negative 9 billion is not a problem, because it is not like a divisions of one company. If you have one company, two divisions, one making money, one losing money, the one that's making money have to, subsidize the ones that is losing money, because you cannot say that, I can bankrupt portions of my company. Just one division went bankrupt, the other one survived. You cannot do like this within one company. But in a market, right, if you have two companies, you own both, one bankrupt, let's say the firm B just went bankrupt, right? You lose this 4.8%, you still have the 95% invested in the companies that's doing well, because they don't do this cross subsidy between firms, right? But when you do a PE calculation, they don't care. They just aggregate everything, right? So they will offset each other. So I think this one just shows that even if you look at the PE, when you look at the PE of the index, these are the stuff that you might want to pay attention to. Because let's say if you say, I'm going to buy, and let's say there's some recession down the road, you want to buy when when the PE is low, right? And when recession hit, all these big banks, they just do a write-off and all this hit into their earnings, right? They actually pull down the earnings of entire index by a lot. So even during like, let's say like recession period, bear market period, you look at the PE also looks high and you also don't want to enter. So just pay attention to these kind of things because the PE of the index sometimes can be quite dangerous. It really like, mess up with the interpretation when you have these kind of things. When we invite YCX to backholder pod, okay, so far our backholder pod, right, we invite people who show up on video, but YCX, he never show up in videos, right? He never turned on his webcam. So if someone is able to convince him to, like show up, of course I look forward to, interview him on the pod. Actually, nothing planned for this. Next one, Tubunti, which books do you recommend for investing? This one, I believe you are in the Telegram group, right? So I actually post the link to my Substack. I list down the books that I've read. Not all, it's just those that I recommend to read. There's one post on that, and then there's another post that I mentioned two books that I read recently. One is the ASML book. I think that one is really interesting to read, especially for those who are interested to learn more about semicon industry, right? That one is quite good. And then the other one, which is the one that I just mentioned, the Jeremy Siegel's book. I think this is also quite good. It's just that this Siegel's book, right, is more, it's written by professor, so it's more like, you will feel more dry, as in there's not tons of story. There's more data than story, Let's say if you are picking up book for, let's say you don't have habit of reading books, right? I would say let's start from books that's like more story-like rather than this kind of like more textbook kind of book. But for me, I read both. Sometimes, stay close to the data. You have more kind of like objective view on the market rather than too much influenced by all these stories. So sometimes I prefer this kind of book to ground us, right? Yeah. So that's more details on the Substack post. I'll put it in the link. Okay, next one from Web. Any expectations of what range interest rates should be in next 5 to 10 years? How does that affect your view on market prospective returns versus prior decade? Okay, this one, I think when we talk about the interest rate, right, I think people are getting philosophical, dogmatic about these discussions. I know there's a group of, let's call it like investors, right, or a group of people who totally don't believe anything about interest rate projection, meaning that you can guess where's the level of interest rate, be it like next year or 3 years or 10 years from now. There are people who strongly believe that no one can predict, and there's a lot of like data to show that, because you can see that all these like projection of where's the interest rate, right? It's not like there's not existent. There are plenty of forecasts, and when people look at all these forecasts versus what it turns out, right, it's like I would say most of the time they got it wrong. So when you ask me these questions to say that, okay, what's my expectations? Of course, if you ask me, I have expectation on all sorts of things. I will make guesses, right? But given that there's like strong data points to shows that like people can't predict interest rate level, so I think I need to say that I need to be humble enough to say that I also cannot predict, even though I have something on my mind, right, to say that okay, interest rate should be around this level and so on and so forth. But it's really like too unpredictable to form any meaningful or useful discussions here. But I will say that just one word before we close this question is that I think given that so much money or so much capital is around, right, like by money I means that if you look at US, right, they're still doing all this fiscal spending and so on. So when you have all this money around and you can see that the US debt is going a bit crazy, right, it's hard to imagine that inflation will go away and will go back to like this kind of like low inflations, 1 to 2% kind of inflation level. And if inflation cannot come down, right, because of all this too much capital around, right, the neutral rate of where the interest rate is, right, it's not going to come back to, let's call it like 2%. I'm mentioning that the long rate. I'm not talking about the short rate, the Fed fund rate. I'm talking about, let's call it like 10-year rate or 30-year US rate. I don't think it will go down to like, let's say like 2% level. It will be elevated compared to the low level prior to the COVID period. Okay, so that's my expectations. And that one is a view on inflations, and the inflation view is by observing the fiscal side of the US side. So that's the only things I will comment. No view on interest rate, meaning that we need to invest in a way that makes sense regardless of where the interest rate level is. That's what we should do. All right, next one. How will you teach the virtues of delayed gratifications to young people or children? This is always the difficult, right? Like how to teach, right? I think this kind of things is the things that when if you just tell them that, oh, you should delay your gratifications. Like for example, I give you sweets instead of like eat it all today. You need to save some for tomorrow. This kind of advice, I think, especially with kids, right? They don't understand one. To them, it's like they want it now, right? So it's hard to come up like with words and thought that this kind of words actually can influence them. I think it's like quite hopeless one if you do these kind of things. But I think one thing that we can set is actually the environment for our children. Say for example, right, I think last week also I mentioned that you cannot live, you cannot make everything too comfortable. Of course, we as parents, we want our children to be comfortable. We want to give them opportunity. We want to help them learn. We kind of like, make things convenient, makes things easier for them, okay? Even say for example, I think there are parents who say that, oh, I'm fine with like, travel public transport. But as and when my wife pregnant, then I need to buy a car. I don't want my wife to, not the wife part. I think mostly they're saying that I don't want my kids to, having need to take public transport. The life is difficult. My life was difficult back then, it's fine, but I want my children to have a good life, right? I think this is natural for all parents, but sometimes I think that you don't need to be too nice to them because you want to give them an environment that is not too comfortable, not too convenient, not like everything is prepared for them, so that they used to live in an environment that is tougher, because you need to toughen up a little bit, right? So that they are comfortable living in a situation where not everything is provided, not everything is like, oh, they just ask, then they get it, right? Because this kind of like conditioning, right, it make them less resilient. Say for example, everything they ask, you give. Then go outside, right, they tell someone else, uncle, can you give me this? Then, strangers uncle say, who are you? Why should I give it to you? Then they get disappointed, right? Because they thought that, oh, I thought the world is such that, well, I just need to ask, then people will give me. Or even, I don't even need to ask, people will just give me, right? So I think need to, how to say, leave them, get them, let them have an environment that is a bit difficult. And when they are telling you that it is difficult, you need to tell them that life is like that. Then over time, they will, like kind of like adjust, and they are comfortable with living in situations where not everything is good. So I think some level of this kind of, challenging kind of environment, I think is a good one. Make them resilient. So, and then if they are fine with an environment that's not perfect, right? In future, it's easier to adapt. Because if they are able to, like earning big income, they want to make their life more comfortable. That's their life, right? But at least they know how to live in an environment that's harsh. So this one, you need to give them the environment to, train up themselves. That's the only thing. Maybe there are more, ideas and more philosophy out there. I don't discount that. It's just that I think, especially in Singapore, right, because life are usually good, people don't have, I would say people don't have much challenges. That's why I will say that many parents, they tend to steer on the side that is like, oh, everything I want to do for my kids. Even it's quite common for parents to like stay at home to, like make sure that their children prepared well for the exams. I think the parent is doing too much. Sometimes I think you need to let them know how to survive on themselves. How do we figure out that management can indeed produce more than $1 of market value by retaining earnings rather than distributing it out to shareholders? I think I followed all these discussions in Telegram group between Web and YCX on all these things about, like, let's say, stock-based compositions, and maybe this question about like the retained earnings versus distributing out. I actually don't have much opinion to chip in here, because to me, right, I find it very difficult to analyze. Like for example, right, let's say you invest in company, let's say Alibaba. Then they say that they are going to give dividends, they are going to do capex of X and X amount, and then they say they are going to do share buyback. All these are, you can call it capital allocations, right? They are distributing money, they are, spending money on capex, on their cloud, and so on. So, I mean, these are normal things. Every company does these kind of things. The difficult part is that based on, even if I read all these, like financial statements in detail, right? I still don't think it is that easy for me to analyze that, oh, they spend, let's say, 3 billion in capex in certain area. This 3 billion is just the nice point. If they're spending 2 billion, it's too little. They're spending 5 billion, is too much. I find it quite difficult to come up with a numbers that I think makes sense. Because, these are operators, right? They have their CEOs. CEO is running the business. They make the call on how much to spend on capex. They make the call on how much to distribute the dividends. Of course, dividends, capital allocations, this one, of course, they involve the directors, board of directors, and so on, right? But still, if we are talking talking about US corporates, right, the CEO is still the one that have tons of power in influencing all these things. And so I find it very difficult, and I don't think I know more than the management. That's why I won't try to judge to say that, oh, all these things, right, they regardless of the amount they spend, right, all these things, I find it hard to assess whether it's a good decision or bad decisions. But what I will do, right, is try to understand every companies that I invest in, right, like what kind of capex that is required. And this one is like, it's not to judge the ability or capability of the CEO, right? This is more to understand like different type of businesses, they require different level of capital expenditure, and then they need, because of all this capital expenditure, they need to have some retained earnings. And then you can also read the financials, reading the past financials, and roughly know that which companies are able to distribute more capitals because they don't need to have so much retained earning, or they don't need to spend too much into all these capex, right? Say for example like Apple, right? Apple, I think that if you compare the amount of free cash flow that the business is generating versus the amount of the capex or the amount of R&D that they are doing, right? I don't think it's just that everything need to fit together. One thing is that they don't spend crazy high amount in like buying GPU, because that's not in their philosophy. They're actually spending the amount that they think is enough to advance the R&D. But because of this philosophy, and because as they run their business, they still produce a lot of all this free cash flow. And there's this philosophy that they say that they are going to return all this free cash flow to come up to end up with a net positions, right? All these are well communicated. So if you know all these details, you know that if I invest in these companies, I know that I'm going to get all this free cash flow. So it just becomes like part of the companies, the characteristic of the company. And based on that characteristics, I decide whether I want to invest more or less. I won't go and judge that, oh, I think Tim Cook should actually do this and that, because they say that they don't want to do. I cannot say that, oh, they are bad, hence they should do this and that, because I'm not the management, right? Even if I have opinion, I can't influence their decisions. But what I can do is just trying to understand their philosophy and then try to see whether that's the right thing or not. If it is bad, right, then I just stay away. That's fine, right? So for the companies that invest in, I don't think there's like a common characteristic in terms of how they distribute their monies. It's more like I have some trust in the management, and then I let them run their business. It's more like that, rather than I need to assess in details. And all this assessment is still based on whatever that they communicated in the past. And still after those, right, I just help me understand the characteristic of the companies rather than saying that I know more than the management. Yeah, it's quite difficult to comment on this. Maybe if you really understand a company like inside out, you will have more to comment. But for me, right, I might spend more time in other angles of the business rather than on these specific things about capital allocations. I'm not saying that it is not important. I'm saying that this is not my focus. And it is not my focus. It's also because I'm not that good in doing this kind of assessment. If I have questions on all these things, right, if I don't have confidence, I just stay away. So that's my approach. Okay, next one. Not all growth are created equal. There are less ideal growth which require ever-increasing amount of capital to finance, resulting in low ROIC. I think this is very true. And it's true if I just compare the companies that I invest in. I think this one, let's say for in Buffett's situation, is quite clear. He did mention that, let's say like the railway business is like high capex. Although you can see the earnings, sometimes you don't see the free cash flow as you need to upgrade, need to do maintenance on the rail and so on. So you can see that even that's why PE is not useful, right? Sometimes PE, you can see the E, but you cannot see the cash flow because of all these capex, right? So this one, especially when you compare companies of different industry, you will appreciate more on this. So I do agree on this. What we want to pay attention to is not the earnings, it's actually the free cash flow. If there's no free cash flow, actually you can't extract cash flow up, right? So this one, 100% agree. But the questions on like there are less ideal growth, I think what you mean is that there are companies where you know that if you put in more capital in, you can increase your earnings. But if you don't get a good ROIC, then you should actually refrain from putting all more capital inside it. So again, it's the capital allocations type of questions, right? I do agree on all these things. And let's say if you are looking at companies like Berkshire Hathaway, they focus on all this, because if the ROIC is too low, they should actually just cut loss, let the thing or just liquidate or just sell out that portions of the business, right? So this is very important. But when it comes to companies like operating companies, right, say like companies that I invest in, I don't think it's that relevant. Of course, let's say take TSMC, right? When I think about high capex, I keep on thinking about TSMC because they need the capital to build all these fabs. And then the question is always that, oh, you spend so much capex, are you still able to get a good ROIC out of those capex, right? My answer to that questions is always yes, because you have seen companies like Intel where I don't know why they just, there's long period of time where they just underinvest, and now you see that they're having a hard time just to catch up, right? I would say that for companies like TSMC, the capex is not just the ROIC questions. Sometimes it's existential, they don't spend enough, the other competitors just become better, and then they will just take away your business and you can't keep up or can't compete anymore. Even if the fabs, right, that they build, right, is giving, let's say, like low ROIC. Say for example, like it give you only 5%, but not spending that capex and get that 5% ROIC, meaning that you will die eventually, right? So which one will you choose? You will still choose to deploy the capital to build the fabs to have the capacity, right? So I think that's the thing. So, but you still need to remember, like you might be seeing a lot of earnings, okay? But these are the earnings that ROIC of the capital that they put in years before, right? And currently they are still putting in a lot of capex to build fabs today, and that will translate to earnings in the future, right? So this ROIC sometimes is also not that straightforward because it's not clear that today's earnings is for which capital that you put out in the past. So sometimes not easy to do these kind of things. Even if you look at the full accountings, I don't think it's that easy to come up with a conclusion. But sometimes we just need to trust the management that they have done enough research and they believe that with all these capex plus the R&D, there's some sort of pricing power, and they're able to up the price of all the chips that they produce, right? So if all those are true, and you trust they have done enough research, I think you will trust that there will be a good ROIC. But if you are skeptics on whether they have pricing power, or you have skeptics of whether they are overspending now, and you have doubt on what kind of ROC that they are able to get, then I would just say that just stay away from this kind of companies, because these kind of companies still require a lot of capex, right? There are companies that don't require a lot of capex, so you can always choose those companies instead. But usually if you look at those companies, I believe their PE looks very high one, because it's like they don't need a lot of capex, right? So the bottom line earnings flow to the cash flow, right? So if that's the case, usually PE looks high. Then you just see whether it makes sense. The capex is definitely something that I'm looking at. We cannot compare $1 earnings versus $1 earnings as if they are the same, right? Because of capex is different. And cash flow, although is a better measure, but sometimes cash flow is hard to assess because there's more cyclical in the capex. Say for example, let's say like Tesla, right? They suddenly just want to build a factory, a gigafactory. All this skew out the free cash flow, right? Because the capex will be it's not linear. So that's the challenging of different metrics. Any comments on how you would look at the business that are capex intensive? I think I just mentioned about this. I think high capex is fine as long as all these capex, you are confident that they are able to translate to earnings and cash flow in the future. Like say for example, right, let's say even companies like Microsoft, where they are buying a lot of all these NVIDIA GPU, right? If you look at their financial statements, I believe all this spending on GPUs, right, it shows up in their capex. They spend the capex, okay? It's not that difficult to believe that all these capex, right, will translate to earnings, because the business models of all these NVIDIA GPU is simple. They are not buying this for their own use. I mean, portion, yes, but quite sizable portions of all these capex, right, is to buy NVIDIA GPU, put inside their cloud, and then rent all this GPU to their customers. So it's like, I would think of this like a REITs business. Like if I tell you, right, my business model is I take all this capital, I spend the capex, and then I buy all this building, I just rent out all this building, right? The question is that you want to ask is that what is the occupancy of all these buildings, right? Because as long as some tenants are willing to rent, in other words, like their customer that want to use cloud to rent all this GPU for whatever, for their training, for their inference and so on, doesn't really matter, right? As long as there's demand for these kind of things, there will be rental or there will be revenues, and all this revenue will translate to earnings for Microsoft. So I think that it needs to be look at it case by case to understand what are those capex, and if you just understand the nature of that capex, right, do you believe that this kind of capex has good ROI? Sometimes we make this kind of assessment without understand, like without looking at the actual numbers, because I don't know, like for every $1 of capex spending on NVIDIA GPU, how much return Microsoft is going to get. Because even if you have this number today, you still don't know this same $1 of capex of GPU, what will be the revenue after 1 year, 2 year, 3 year, 5 years, right? Because the GPU can still be running, but we don't know what is the rate or what is the rental that they can charge. So there's still some uncertainty there, but the dynamics or the basic picture is still the same. It's still, like capex on the hardware and then just rent out later. That's their business model. Microsoft capex on all this GPU is different from Tesla capex by building out their gigafactories, and it's different from TSMC capex on building fabs. They are all different in nature, but we are all assessing the same thing, which is that can all these capex, generating more revenue, more earnings, and are these capex done in disciplined manner? So I know I'm posting more questions than answering questions, but these are the things to look at. It's not that simple. You basically need to align back all this spending back to their philosophy or of the company. Say for example, like Tesla, right? Even if it is low ROIC, let's call it like 5%, right? It's not fantastic, right? But to me, I'm still happy with this company come up with this kind of capex, because their philosophy or their goal, right, or their plan is to build enough gigafactories to churn out enough cars to, like turn this entire auto markets become EV, right? So growth is embedded in their strategy. So you cannot say that, I invest in this company because of the growth, and then at the same time, I don't like they spend all this capex, right? So sometimes all these different KPI or different variables, it need to fit to the same philosophy, it need to fit to the same strategy. And once it's in line, right, even if the capex is having some ROIC that is not fantastic, right, you will still be saying, oh, okay, it's okay, because I think that I want to join together in this path together, because I believe in this overall strategy, right? Instead of like just, crunching numbers and then you don't even know, like when they spend capex, what is it for? Like how does it fit into the overall strategy of the company? So all these need to piece together for individual companies. Conviction is a word commonly used as a measure of confidence. In your opinion, what variables go into the conviction function? How to keep it rational? I think convictions are sometimes is a bit like overused, because when you heard someone say that, oh, I study this company, I have high convictions, or this company dropped in price 50%, 70%, but I still have convictions, They kind of view, I would say that sometimes it just tell you that, this person is like still believing on his thesis, and that's it, right? What other things can we get out of this, description of about like conviction? So at least I myself, I don't think I use this word that often, because to me, I have conviction means nothing. But if you ask me, do you still have conviction on, let's say, company XYZ, right? I would say, I won't say you I still have conviction. I will tell you that, okay, why I'm still holding on. Am I betting on certain trend that will still come back, or that will still continue? Or I still believe on the fundamentals or my thesis, which is reason ABC, right? I might be able to list it down, and then you can make your own assessment on the ABC. But the conviction itself, I think, is a bit hard, because it tells us nothing much. Then the question is, what variables go into the convictions? I think this one definitely is about the understanding. If someone asks you, like, let's say one person, they say, oh, I have very high conviction on company XYZ. You try to challenge the person a bit, right? You say that, what do you think about this angle? What do you think about the long-term growth rate? Or what make you think that this sector will do well? What about the challenges coming for another competitor or another industry, and so on, right? So as and when you have more questions to try to challenge a bit, like try to understand more, then you will see the true convictions, whether the person is able to answer or not. The person may say that, oh, these are the things that I don't think is important. Say, for example, he invests in company with high growth. You're asking, like, okay, this high growth company is making losses, and every year losses getting bigger and bigger. Then you ask the person, are you worried about this company can go bankrupt? Then they say, oh, I don't look at financial, I just look at the growth. Growth is 80%. To me, high growth is good enough. Then you ask 2 or 3 more questions related to, let's say, like, capex questions. You ask about capital allocations. You ask about, like, can the management be trusted or not? You ask 3 or 4 more questions, then the person keep telling you that, oh, I don't know, I don't care, I don't know, I don't care. I still have convictions because growth is high. Then you can ask, like, oh, if growth suddenly just become, instead of 80%, come down to 15%, what will you do? Then the person just can't continue with this kind of conversation anymore, then at least you know that actually the convictions, actually there's nothing there, right? It's just based on one variables that can change. So to me, this kind of things is like the word itself got no meaning, but as and when we discuss the rationale of certain investment, we keep on like prompting for more and more things, then only you know where's the source of the conviction and can make an assessment on whether you can actually like have confidence on the person's convictions. So I think it's quite fun to have this kind of interactions, because to me, a person's have conviction or not is useless, but if you have good enough questions to prompt it, and then from the the commentary, sometimes we learn something new. So that's the things that I find more useful. Okay, so hi Mr. Loo, we will buy Palantir stocks. Maybe I try to ask when we have the recording. But I think these questions, you can see whether I'm correct or not. If we ask this to Mr. Loo, he will tell you that he don't know how to pick stock. Then maybe he will tell you, oh, he interviewed Christopher from Provident, he interviewed the Endowers chairman, and all of them tell you the same thing. They don't pick stocks because picking stock is difficult. So buy the index is the better way. I would assume he would say these kind of things. So other than he will tell you like Palantir is bad or anything like that. If you watch enough his video, I believe you will have good understanding on what kind of like response he will give. Hi Bunty, if you were to review your current allocations, what's one thing you think you have done well, and what's one that you can further improve on? I think the part that I have done well is that keeping up to the winners. If you look at Nvidia, right, I mean the result is really like much better compared to my expectations just 2 years ago. So it's a lot better, and I didn't paper hand and just lock in the profits. I think that's already something that I can say I have done well, and this one is thanks to invest for the long term, right? Because I also, when I tell people to invest for the long term, I'm also trying to convince myself, don't overtrade, don't knee-jerk, just holding to the business. If the business have done well over a long period of time, my portfolio returns will be fine. Okay, so I'm also convincing myself when I say that, right? So I think that's the part that done well. Okay, then the part that I think I can improve on, I think it's the same thing, right? It's just the flip side of the same thing. There's this investor that say you need to cut your losers, right? So if you look at my portfolio, right, I think there's still quite a number of so-called the losers. Maybe I can name a few, right? Let's say like Meituan is one. Let's say the Snowflake is one. China, Tencent also you can consider as one. I think the smallest one, if you look at, even now Tesla, you can say it's the same thing. All these, right, like recent 1 or 2 years, their performance isn't great, including their business also not doing super great. If you just read the financial, you will understand. In the case of Snowflake, maybe it's like just the growth has slowed down quite a fair bit. Then in the case of like China overall still down, right? And Tesla, you look at the car prices after they do multiple rounds of all this price cut, right? Actually, the financials is not doing that well even now. I've discussed this in past episode, right? If I say can improve on, actually is to be slightly more reactive on this, because sometimes we say don't knee-jerk, is that you don't knee-jerk on like things that happen on like monthly basis, right? But sometimes all these deteriorations, it stretch 1 year, 2 years. So sometimes the trend is also quite clear already, but because of invest for long term, right, I choose to like just bet hold, do nothing about it. So that one actually drag down the returns. If you say can do better or not, I would say that this kind of, I would say sometimes it's hard to come to a balance. Because if you do this, the second part, which is like just cut your losers, if you do a little bit more active on this, sometimes you might just cut away like the turnaround. Say for example, like Facebook, right? I actually cut Facebook or Meta like few years back, right? But then it become like a great turnaround story, and I missed that, right? So for those names that I still keep holding on, I mean, with hindsight, if I just cut it out, I can like improve my returns. But there will be situation where I cut out already, there might be some turnaround story that I will miss that. So I think investing, right, or so-called the long-term investing, is always a balance between these two. You can adopt like the extreme buy and hold, don't do anything. I think if you do that, then you can expect to have some multi-baggers as long as you spread your bullet wide enough, and you don't panic sell as and when all this you have some like relatively good returns, right? You sure will have some multi-bagger given long enough time. But if you just do extreme buy and hold for a long period of time, you also need to expect there will be some companies that bankrupt or just lose like 80% over 10, 15 years or period. No? So that is just like the implications of the style that you choose. No? So I think improve, I think sometimes some rebalancing still okay one. It's just that you to strike a balance on how reactive you want to be. I think there's no easy answer to that. It's just it's a matter of style. So I doubt that, let's say if I do this often, overall result will be better or not, I actually don't know. Because like I said, if I try to, like just cut the losses, I might, like save some capital from all these long-term deterioration kind of situations, but it kept my returns, right? In your opinion, what are the important elements of the educations for successful long-term investor? What are the first things to understand deeply? This one I have wrote a Substack. I will put the link in the description for those who are interested to read on this. Basically, I'm giving a few points, right? Say for example, like as an investor, you need to know the expected returns, because I noticed that this is the part that many people lack. People don't try to study the long-term expected return. They don't even know that, let's say if they put their money in stock index, right, what kind of level of returns that you can expect to get, right? So this kind of things is like, I would say it's not like fancy things. It's more like just reading the historical data, reading the research that other people have done, and then come to a reasonable expectations. Because if your expectation is reasonable, you will have less shock or less disappointment. Because sometimes it's like you invest for, let's say like 10 years, you get 7% returns, right? For some people, they will say that, wow, I thought that I can, like get 20% returns. So getting 7% return, they will say that it's so only, it's only like 3% above CPF, SA, right? To me, it's like, even if you can get 7%, it's still like good, given that the overall market returns isn't that high. Because historically speaking, right, it's only about 10%. And that was the period where the starting point period where the PE was like quite low, right? Nowadays, because all this PE is relatively high, if you can get like 7%, to me, even 7% could be, like a little bit of underperformance compared to the index, but it's still not too far away, right? 7% is still quite decent. So I think these kind of things, if you read enough literature, you have a reasonable expectations, it helps you ground you to what to expect. And if you know what to expect well, right, I think it helps you to structure your investment. Not so much about like getting the outperformance. That's a totally separate story. Then the other things that I mentioned is about like, let's say like risk management, focus on the like still come back to value investing, that kind of things. The next one, sometimes companies can make big profits without much managerial effort, but it's possible that little of these profits accrue to shareholders. Then what are your thoughts on corporate governance with respect to protecting shareholders from managerial leakage? Let's say if I study businesses, right, and then I notice that two companies, let's say, right, they operate in the same industry, and then sometimes it's like, okay, this industry could be in environment that is like really good for them. They are earning monies. So even so managers, right, can get good returns, good earnings, good growth, right? Just because of they are riding in certain trend, right? So do I discount the managerial skill in this? I find it like hard to compare companies like this, and I find it hard to assess situation like this, because to me, when I do individual companies analysis, I really need to go into the individual companies and first just understand like what's their philosophy, like how they manage the companies, what's the overall value propositions of the entire business. So you need to follow the company's stories, how they tell the stories basically, rather than just understand like, oh, they have so and so results. Can I separate the skill from the environment? The factors, right? Because I think all these are important. It's just that it's too difficult to separate out, because it's really difficult, right? Because we don't know. Say for example, right? You see Apple, they've done well over the past 10 years, right? You ask me like, just looking at the financials, can I like separate out like are they like the business is good because of the booming of the mobile market, or is it like the company's managerial skill is really like outstanding, right? Sometimes I think it's difficult to split, and then sometimes these things are like they are entangled together that you cannot separate them easily, because the entire mobile revolutions is there also because of all these players in the market, right? So it's too difficult. So don't know how to answer that. But let's say if I found it that okay, why certain industry, every companies have done well, and to me it's like nothing too much to do with a managerial skill, right? One example I can think of is, let's say if you study energy stocks, You look at Chevron, you look at ExxonMobil, and so on. And then you look at all of them are doing well because oil prices are good, right? Or if you study banks, say for example, you study OCBC, DBS, and UOB, right? You say that, oh, all of them are doing good. And is this managerial skill, managerial effort? Sometimes I know that the answer is no, because sometimes they are doing well just because the industrial environment is good. Sometimes it's just because oil prices are high, so the result is good, right? You can't justify that, oh, all these are skill. Of course, skill is always there, right? You still need someone to like manage the business and so on. It's just that the outstanding result in certain period of times sometimes got nothing to do with all this managerial skill, right? We can acknowledge that, but it's just that when you buy into a company, you are getting the whole package, right? If I find it that in the case of, like, let's say energy stocks, right, I find that actually what is driving all this result is the oil prices. To me, it's like just commodity business, right? I do, even if I buy, let's say like ExxonMobil, I won't say that, oh, because their manager is great, because most likely I buy into the company just because of the business. Maybe I have an outlook that the oil prices will not come down, it will continue to go up, say for example, right? Then to me, it's like buying those companies without an assessment on the managerial skill is okay, because the managerial skill is not the thesis of this investment, right? I know all this is important, right? Just that it's hard to make commentary on surface like this, because let's say if we have sample companies, right? If you and me, we read the same companies and then we come and discuss, right? And then we discuss the aspect of managerial skill for that specific company, right? And try to justify that is the manager a good one. Sometimes we might need to say that, oh, you might want to know that, okay, the result is good because of the tailwinds, because of the trend, cyclical trend, and so on, because of the industry trend. So those are important things to bring into the picture. But it's just that on the surface, just reading these questions and come up with insightful things to talk about, I struggle. So I give it a pass. I don't think I give myself an A for this kind of response. If I disappoint you, please don't whack me. Okay. Next one. How can active investor who choose to dedicate significant effort in studying and picking businesses prevent the mistake from selling compounders too early? I think this one is really related to the answer that I mentioned just now, which is that, like some people, they just hold on. Let's say the guest that I interview, right, in Bagpodholder Pod, right, he hold on to Netflix and then get like a few hundred multi-bagger. Sometimes I don't think there's way to, let's say if you follow the companies and you say that, oh, I will continue to hold as long as indicator ABC continue there, right? If you come up with this kind of rules, whatever rules, right, I'm sure that there will be period that if you just follow those rules, you will just liquidate already. Because there's all these, like any good companies, they also face crisis in the past. So if you follow those kind of rules, I'm sure you will liquidate. Some people, they don't liquidate not because their rules or their strategy is better. Sometimes it's just that they kind of religiously just want to stay invested and see what's happened to the company, right? To the extent that just, I don't care really, buy and hold. Anyway, I like my asset base is big enough. Let's say if even for this specific company that just, U-turn and drop the 20%, 50%, I'm still fine. They will just let the winners run and just keep it at that, right? So this kind of way, is it like very, advanced? The answer is no, but it's just that it help you just to, like keep to the winners. But I'm sure that if you have this kind, you push the extreme, for sure you will have some companies that, turn out to be a winner and then you turn back, right? So then you need to just accept that that's the implications of this kind of style. But of course, if you dedicate enough time and invest in the company, let's say take Berkshire, right, as an example. I believe those investors that invest in the companies for, decades, right, they just hold on and hold on. If you ask them like why you're still holding to these companies, I don't think they will tell you things like that is like time sensitive. They won't tell you, oh, I hold on to Berkshire because their, like let's say their earnings yield is above certain percentage, or their growth rate is above certain percentage, right? So I don't think they will come up with that kind of things. Sometimes they just say, oh, I invest in this company because I trust Buffett. Your follow-up question will be that after Buffett is gone, will you still be invested with this company, right? I think that could be a good follow-up questions. But I think usually this group of investors, if you ask them, they won't look at things that that change, meaning that if you have trust on Buffett, I mean, you will continue to have trust every year, right? So it will be things that stay true for a long period of time. Say, for example, they tell you that, okay, Berkshire Hathaway, I invest because the businesses are generating tons of cash flow. If you read their financial, you will notice that the characteristic of the Berkshire Hathaway holdings is to own businesses that generate cash flow. So, and generating cash flow, to me, is not that difficult. Say, for example, if you just buy REITs, right? REITs also generate the cash flow one. So as they continue to generate cash flow, then you continue to hold. And so if you invest in REITs, you will keep on continue to hold. I'm not saying that the cash flow will continue to grow. I'm saying that they will continue to generate. Sometimes cash flow a bit low, it's not a matter, but they still continue to generate, right? I don't know. I think this kind of situation is that for me, it's like those who hold on to a winners for a long period of time, right? They tend to be like me, they just focus things that don't change. So they just hold on. Some people, they focus too much on things that change. So back to the same question again, right? Things that change. Things that don't change is like culture, philosophy, business model. These type of things rarely change. Then followed up by fundamentals. Earnings growth, free cash flow growth, revenue, all these things. Then the things that change every day is the prices. So you just look at every investor or speculators, right? You just ask them what they focus on, right? And then from what they focus on, you know what is their turnaround. There are two types of people in the investing business: those who are humble and those who are about to be humbled. Any comment on virtues of humility in investing? Yeah, this one quite easy one. Those who are not humble, they are not in the market for long enough. Once they are long enough, right? After you lose enough money, then you become humble already. Yeah. Okay, demand for compute has always been crucial in modern human civilizations, and it only seems to increase exponentially. What do you think are the fundamentals? I think the fundamentals, right? Take a step back. I think the fundamentals is just that the consumers, they want more and more. And by more, right, it's not just like more. It's like they want better things. Just one good example is like, in the past, right, let's say like the screen, right, we are used to what the resolution of 1024 minus 768, the low resolution, right? Then people want like better resolution. Then we have HD, then we have full HD, then we have quad HD, then we have 4K and so on. So this kind of things is like people always want better, and there are things that you can justify, or having more pack density means it's better, right? So that's why as you have more and more pixel, you need more and more compute power to push all these pixels. That's where the demands come from. So that's one. And then the other thing is that in the case of GPU, right, is that aside from people wanting more, they like more of the same thing, right? They also want more of the new things. Say for example, let's say like the GPU, if you apply GPU on whatever existing computing that people needs, right? Actually, you don't, for the existing one, it tend to go up linearly. But there will be new features, new tools, new things that come out that require different way of computing. And people want that. Say for example, there's no ChatGPT 5 years ago, and then as and when OpenAI come up with ChatGPT, people want it, right? And all these wants, right, is like it can come out because of there's such computing that able to support, right? And all these are heavy computing, right? Heavy GPU is needed to run all this training and inferencing. As and when all these services come up, people want it, and people want it faster, and they want more stuff. It's like, it's not enough just to have a chatbot to talk to me and help me do research. It's not enough. I want agent AI, where the agent can just operate on internet, just achieve their goals, right? As and when you have more and more all these agents around, right, you need more inference compute power, right? So all this will keep on increase. So that's why if you just track the energy usage per capita, you track all this compute per capita, all these things keep on increasing. So this is just the natural improvement of human civilizations. Yeah, so I think these trends will not end because people will always want more. What do you think are the fundamentals driver causing the need for more compute? Which businesses do you think will emerge as beneficiary of this? Do you think that the trend never ends? Yeah, I actually think that the trends will not end, because people always have a drive to want more things. And come back to the drivers, right? The fundamentals drivers. I think, yeah, just think of it like the fundamentals drivers, right, is that people want more things. And from the one more things that create more services and more powerful kind of services, and all those actually require more things. You just track yourself. For example, you have subscribed to, let's say, like Google Drive, or you have subscribed to Dropbox, for example, right? Would your demand for this kind of things reduce over time? Of course not, right? Because every day you have more things to throw into your Google Drive, and then every day you are taking more photos, and then all these photos are put into like the Drive, Google Photos. So all these demands keep on increasing, and then all this plus the ever increasing resolution, ever increasing quality. Like today, I'm uploading this will be in, like, let's say HD, right? I think HD now people seems to be happy with HD, but let's say 5 years later, 10 years later, everyone watching 4K, I have no choice but to upgrade 4K, because by then, right, people look at the HD video, they will say that, wow, the color, the resolution, why so cui one, so bad one. So I need to have keep upgrading my equipment to make sure that I am able to generate all this 4K, right? And as and when I produce all these 4K videos, suddenly my PC is not enough already. I need more compute power. I need more drive. So I think all this, the digital world, right, is supported by all these hardwares, and because of the demand for more quality, better, and newer kind of applications, it will keep on demanding more and more compute, more and more storage, and so on and so forth. This one won't end one. Hi, Mr. Loo, do you still believe in CPF and RA? Do you feel the recent happenings is the start of the goalpost shifting phenomenon? Interesting. I think he answered the first part, right? The CPF and RA, I think he's still a believer. He said he's going to live until 120 years old, right? Just to make sure that he get a super good ROI from his CPF, right? So that one he has commented about. The part about goalpost shifting, I think he also commented on this. He mentioned about like all these things are only is because it makes sense, because if you can only deserve a higher returns if your money is illiquid and is tied up. You cannot expect to have a liquid cash at the same time earning a decent yield, right? So I think this one is just to align the liquidity versus the expected returns, to be fair to all the CPU members. So I think that's his comment in the past, but I will check with my bagpodholder crews, see, because they're also like brainstorming other questions, right? We might have already good number of questions. Keep on posting if I see all these good posting, or you can mention in the Telegram group, right? If there's any interesting questions, we will post it to Mr. Loo. Thanks a lot for commenting on this, or at least raise it to my bagpodholder crew. Thank you so much for tuning in. Thanks a lot. I see there's like 134 of you here. I'm quite surprised to see this kind of number. Thanks for dialing in live. All right, see you in the next one. Bye-bye.